Okay, so now let's look at stock warrants based off of an incremental method. And incremental method is usually we can't determine the fair value of either the warrants or the bonds. So we have to look at one of them. And basically how we look at it is if we can determine one of them and we know the cash that we're going to receive, then we basically subtract and have the difference. The difference ends up being either the warrant or the bonds. Okay, so if you usually know one, we can determine the other based on the cash that we receive. Okay, we allocate the remainder of the purchase price to the security for which it does not know fair value. Okay, so let's look at this illustration. This is McCarthy, issued 2,000, 1,000 bonds at 101. So we know, once again, by just the issue, we issued it at 1,000, or 101, excuse me. And because we issued it at 101, therefore, we know this is the amount of cash that we received, okay? Which is $2,020,000. Each bond was issued with one detachable stock warrant. After issuance, the bonds were selling in the market at 98. So in other words, we know that this combination of a bond with a warrant was selling at 98. The problem is we don't know what the market price of the warrants without the bonds would be. So because we don't know the market price of the warrants without the bonds, we have to determine what this incremental method, what this allocation should be, okay? So how we simply do that is we take the fair value of this bond at 98%, that gives us 1.96 million, and we take the cash received less the bonds, and that determines the value of the warrants to be $60,000. And if you notice, that's what we have right here, okay? Also notice, once again, we have to determine our discount, which is the face value of the bond, which is 100, times 2,000 times 1,000, which is 2 million, less the allocated fair market value of the bonds. That gives us a discount of 40,000. So we have to record this discount. So how do we do this? So basically, we know that we received cash of $2,020,000. We know we have this discount on the bonds payable. We also know that we have a bonds payable of $2 million at face value. And guess what our plug will be? Our plug is the paid-in capital stock warrants. Okay, so we have these stock warrants at $60,000 as our plug, and so this here is given less the face value. Okay, this is given, and this is our plug. Okay. All right. So let's look at conceptual questions on the stock warrants. Detachable warrants involve two securities. They involve the debt security. They also involve a warrant to purchase common stock. Non-detachable warrants say this: we don't require an allocation of proceeds between the bonds and warrants. Companies record the entire proceeds as debt. So what happens is, if a bond is issued with a detachable warrant, in other words, we can separate the two securities. And if we can separate the two securities, then therefore we're going to record them as two separate securities. We're going to record it as bond, and we're going to record it as a warrant. When it happens is there are times when they're considered non-detachable warrants. You can't separate the proceeds between the bonds and the warrants. They really sort of come in as one and they leave as one. And so when that happens, the companies record the entire proceeds as debt. Okay, so there is no separation. We record it for conservative accounting, all of it as debt. All right. So we have the right to subscribe additional shares. Stock right. Existing stockholders have the exemptive right to purchase newly issued shares in proportion to their holdings. And price is normally less than current price of shares. Company make only a memorandum entry. Okay. And we talked about preemptive right in chapter 15.